Money radio for a really great future. We're talking real money.
Well, once again, it's time to get educated. About something really important that we talk about all the time on the show, and it's in the name of the show, money, talking real money. You need to know how money works. You need to know how it works. Your parents need to know how it works. Your kids need to know how it works, because money is what keeps us going. It's the fuel for our existence. And we talk about it regularly every Saturday right here on the radio that becomes a podcast later. And we want to help you out. And you can ask us questions right now by calling us at 855-935-TALK, 855-935-8255. I'm Don. Tom's over there. You're there. And, recently, about 120 high school kids actually competed in something relatively worthwhile, the National Personal Finance Challenge in Atlanta, just about a week ago.
Is there ice water involved in this or not?
No,
this
was about money.
Ah, okay. And by the way, at the state level, there were almost 20,000 kids involved, which I love. I love the fact that they're learning about this.
But think about that on the grand scheme of high school.
It's a small number, but anything is good. I mean, this is good to get people talking about this kind of stuff. And we want to salute, by the way, Scripps Ranch High School in San Diego that took the top prize.
It sounds like a rich high school, doesn't it? It really does. Scripps
I was
Ranch,
waiting for you to say
for
that.
a minute. Yeah, there are, by the way, there are 17.3 million high schoolers. Yeah.
Okay. So don't make me ask that.
1/100th of 1%.
It's a small number.
1/10 of 1%, I think, participate in this thing, which is really important. It's important that you understand the basics of money, and none of these questions that these kids took on were all that difficult. But I'd be willing to bet if you stopped most people on the street, like a la Jimmy Kimmel with his stupid questions that he asked people, like, what country is that? And it's the United States, and they go Australia. I mean, really? I think most people would probably fail miserably, Tom.
Well, we had the piece a few months ago talking about literacy, and remember the 3-question survey, less than half of people got that one right.
Well, this one is a 9-question survey, and you can play along with us at home if you'd like. The first question on this quiz, and I'm pretty sure Tom knows this one. It's a basic money question.
Please, I hope so.
What is the term given to the amount in an account that is separate from any earnings or interest that has accrued? Is it A, the balance, B, debit, C, principal, or D, credit? Think about that for a minute. The amount of the account that is not the earnings or interest is the...
And, Don, because the last name is Tom Cock, I'm going to go with C, principal.
Exactly.
Oh, okay. I was waiting for a ding, ding, ding or something.
I know. I forgot. Let's see. Do I have any sound effects?
I don't have anything. Come on, man. That's what I count on you for.
I was really bad at this. Yeah. The correct answer is, in fact, C, principal.
What you put into it.
The balance would be the earnings and the principal.
Correct.
The debit would be the money you take out, and the credit would be money you put in.
Yeah.
Now, this is something I found interesting. Question number 2 is about retirement.
Yeah, I mean, this is kind of a hard question.
With respect to required minimum distributions, what is the difference between a Roth IRA and a traditional IRA? A, with a Roth, you have to take an RMD. With a
No. With a Roth,
you don't have to take an RMD.
Very important.
With a traditional IRA, you do. With a Roth, you have to take an RMD. With a traditional IRA, you don't. With a Roth, an RMD starts 5 years after retirement. With a traditional IRA, it starts 10 years after retirement. With a Roth, an RMD starts 10 years after retirement. With a traditional IRA, it starts 5 years after retirement. Now, they
because
made those complicated answers there at the end for people to go, wait, is there a 5 or a 10-year rule?
Okay, I mean, at the start, though, let's make it simple. With a Roth IRA, do you have to take RMD? The answer is no. So that's pretty easy. You can go right with A. You can eliminate everything else.
Exactly.
Right there.
Look at how he got that right off the bat. 855-935-TALK is our phone number, 855-935-8255. Hey, if you want to take on one of these questions, call us right now.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Yeah, the program continues. I'm Don. That's Tom. We're talking about money. We're actually talking about a competition that was held recently in about financial literacy. And you congratulated the kids at Scripps High School? Scripps Ranch High School? Scripps Ranch High School, yeah.
Yes.
Yeah, the average annual household income at Scripps Ranch is $220,000 a year. That's the average household.
Being wealthy.
Well, and they're going to be, by definition, they're going to be more financially savvy.
One would think. By the way, I want to make sure we finish up on the RMD question. Just to be clear, first, you do not have to take a required minimum distribution from a Roth IRA. Number two, the time when you have to start taking money out of a qualified account like an IRA or a traditional 401k has nothing to do with how many years after you retire, has everything to do with your age. If you're born before 1960, you have to start taking that out at age 73. If you're born after 1960, you get to wait until age 75. So those are important numbers to know.
Too early.
You're way too early.
Oh, dang it. Dang it. I'm going to skip the next question because Tom doesn't like it.
It seemed...
Because it's about insurance and it's not about investing. And he's very focused on the topic.
No, I just didn't think it made a whole lot of.
It makes total sense, but nobody needs to know it unless you're a kid at Scripps Ranch working in the insurance industry soon.
At age 17.
Well, you're going to be following in Dad's footsteps.
I see. Okay.
Question 4 then.
Yeah.
What is the primary reason that certificates of deposit, CDs, offer higher rates of interest compared with regular savings accounts? Here are the answers. A, they invest some money in high-grade bonds. B, interest isn't always paid on time. C, they aren't insured by the Federal Deposit Insurance Corporation. Or D, they require funds to be locked for a fixed term.
All right, so we had a C, and then we had an A, right, so far. So I'm going to switch things up here a little bit and go with a D.
Yeah, CAD.
CAD, CAD.
CAD. That's why they pay more, because you are locked in. You get a penalty if you take the CD out before its due date. And
by the way, they might invest it in high-grade bonds. Who knows?
Who knows? That would be the bank issuing it. But
that's what I'm saying. Yeah, correct. But they can do anything they like with the money.
Actually, you're right. That could be a correct answer if interpreted different. Basically, the bank might buy bonds with it, but generally the bank is just going to lend that money out to somebody else.
And interest is paid on time, and they are insured by the FDIC. So,
number 5, if an employee is vested in their retirement plan, what does that mean? A, the employee can receive their contributions even if they leave before retiring. B, the employee can receive their contributions and their employer's contributions, even if they leave before retiring. C, the employee is promoted and gets a higher company match. D, the employee is a senior executive who wears a three-piece suit to work. Well,
including the vest.
D could be the correct answer for some.
Yeah, because you're vesting. You've got a vest.
Oh, I get it. That was the vest.
Yeah, there you go. Remember, we used to have vestry, too, the vest.
Yeah.
Anyway,
I wanted us to all wear vests, and you're the only one who did.
I know. I'm the only one. No, I won't say that. All right. So is it you get to keep your contributions, you get to keep yours and the employer's, or you get promoted, or the silly answer about the suit. Well, it's pretty. Vesting is truly when the money is all yours, and that includes what you put in and what your employer put in.
Yeah, your contribution, you're always vested with your contribution because it's your contribution. The company's money, though, they can withhold for a certain amount of time to make sure you're a long-term employee. It's a way to incentivize you to stay. And so they put a vesting period on the money they throw in. And once you're vested, it's all yours.
Yeah, and I think with us, it's 6 months. I dislike this practice in a general sense, but because I'd rather see day one, you're vested, you're ready to go. I think when we had our company, anything went in there that we did, you get it all.
We were simpletons. We just made it simple.
Well, there may be that.
We made it simple.
Yeah.
All right, we're skipping ahead again. We're going to skip to number 7. Because
just so I know, is it comprehensive or liability? I think it's comprehensive.
It's comprehensive.
Right?
Okay, I'll ask the question. On your way to work, you get caught in a hailstorm. What type of car insurance covers hail damage? Comprehensive.
Yeah.
Not the umbrella, not the liability, not the guaranteed asset protection, whatever the heck that means.
That's
number 7.
Some other product, yeah.
Some dude named Fred.
Yes.
Does not believe in banks and keeps his money in a sock buried in the backyard under his new concrete patio, along with the body of various mobsters. Bodies. He faces little risk of having the money stolen, but his sock money is subject to what kind of financial risk? And I love these answers. A,
yeah, they're good.
Inflation risk. B, ask D.B. Cooper, mold risk.
DB's out there spending it, isn't he? Okay.
No, they found molded money in the
they
forest.
Did. Yes. And they found it right there at the edge of the Columbia River. Actually,
well, it was in the woods, kind of
in the sand or the
longevity risk.
Yeah.
Or interest rate risk. What is the risk you face if your money is just sitting there in your mattress, in a safe, under a pillow,
or in a bank account, or in a savings account
with no interest in a
offered by it's $18 trillion or some number. It's a huge amount, not buried in the backyard, but buried at a bank that's paying nothing. I think you face inflation risk, right? Because the price of things go up.
As inflation rises, the value of your money, the spending power of your money, declines.
Yeah, and
declines.
Losing. This is something we talk about regularly with people when we meet with them who have a lot of money in regular savings account. I call it losing money safely.
And just because I love these two next questions so much, because they're really pretty complicated. They're actually a little bit complicated. They're most people probably won't know the next two. Therefore, since we have a call, we're going to go to the phones.
That's a good idea.
By
Break
the way,
it up a little bit.
Our phone number is 855-935-TALK if you'd like to call us. And we're heading to Illinois, a long way from Washington. And Hillary, welcome to the program. Hello,
Hi,
Hillary.
Tom and Don. How are you?
Good.
Doing well.
Hello.
Yes, ma'am.
How are you?
We're doing great.
I'm so
Thank
glad
you.
that I got to talk to you.
Yeah, what's up?
Thank you for that. Yeah.
I have a question about a mortgage. And I am buying a house, and then I will sell my current house later. So all the equity in the current house will be, I'll get that after I get the mortgage on the new house. I should have quite a bit of equity. I should get it quite a bit back when I sell the house. And I'm not sure, given interest rates going up, whether it's better to then use that equity and pay down the principal, or whether it would be better to put the equity into my brokerage account and just pay the mortgage as agreed.
I don't know. I'd have to know more.
Well, okay.
It's hard to answer. Don's got an answer. Sure. What do you say?
I've got an answer. It really depends on what the interest rate is on the mortgage. If the interest rate on the mortgage...
Hold
on
I was going to ask, was there a point where...
Yeah, exactly. That's what we're talking about. We're talking about, is there a point at which it makes more sense to invest? And we'll cover that right after we do this really quick thing we have to do.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Our phone number is 855-935-TALK, and the question from Hillary is buying a house, selling an old house, what to do with the extra money that comes out of the old house. Should it go into the new house or should it go into investments? And there are a couple of things to consider, Hillary. One is the purely financial question. The current rate of a 30-year fixed mortgage is right around 7%.
Yeah.
It's kind of hard to beat that with any reasonable amount of safety.
Yeah, well, with any investment, we know the average investor probably who is a buy and hold long-term probably makes around 7%.
In a balanced kind of a portfolio.
Yeah,
so
exactly.
The odds are good that it'll be a better financial decision to put it into the house. However, there's another fly that sneaks into this particular ointment, and that is the illiquidity of a house.
Yeah.
Would this money ever be needed for any other purpose other than to put a roof over your head? If the answer is no, then financially the better decision is to pay down the mortgage.
Except the other part would be, do you have sufficient savings?
Yeah, that's what I mean.
And how close to retirement are you, for example? Yeah. Because one thing we see is people that are sort of house rich, cash poor, they can't pay the bills because they got it all tied up in real estate.
And then they have to borrow it at an even higher rate out of the real estate.
So do you have money saved? How close to retirement are you?
I've got plenty of money. Yeah, I've got plenty of money saved, and I'm going to be getting a pension that's going to be 85% of my current salary.
Love it.
So I don't anticipate needing the money for anything other than, paying the mortgage on that.
Then this is going.
It either is going into investments and then being used to pay the mortgage, or it's going into the mortgage. And I was leaning towards just putting it down on the principal, but I just wanted to make sure I wasn't.
Yeah, you're going to force me to agree with Dawn here.
If rates were 2.5, I'd say put it in the investments.
Yeah, different situation. And frankly,
I'm getting rid of a 3% mortgage. I really don't like that.
Don't move. Don't move.
I know. I did that a year ago. I hated it. But I think Dawn is correct in this case. Yes, pay that down.
Yeah.
You've got some liquidity. You have this nice pension, so your future income is in a good place. And what this is going to mean is your payment, hopefully, on the house will be lower for a long period of time. And you won't have as much debt at 7%. It's not expensive money compared to, I looked up, my first mortgage was twice that. So people out there complaining, it was a lot more in the 80s, but it is expensive compared to just a few years ago.
Yeah.
Well, thanks for calling, Hillary.
Thank you so much.
We appreciate you. Take care. There's so many things to factor into these kinds of decisions. It's the liquidity, it's the return, it's the degree of safety. It's also just comfort, psychological comfort.
Yeah,
sometimes it feels really good to have a house that's paid for. I got to tell you, if we ever sold this house, we would downsize to a smaller, less expensive house. And we would probably just, at particularly these rates, go ahead and pay cash for it because, again, that's security. We've got enough money to live relatively comfortably, and it's just knowing that even though you're still paying interest and taxes, that basically that house is yours until you have to leave it to your kids or something.
I've got this place I'm in right now. I can get you in here cheap.
No.
Really cheap.
On the lake?
Yeah. Oh, yeah.
You paid up for that thing. I know. I was
No,
there.
this house, I'm not in that house.
Oh, you're
I'm
in the little behind house.
Exactly. You've stayed here. You know the deal.
ADU, it is small, but it is gradually
Got
becoming
everything.
a smaller version of the Model Military Aircraft Museum.
That's true. It is, yeah. In fact, another one's going up this weekend. So I think the Japanese Jill bomber is going to be taking wing soon.
All right. Now, here's the deal.
Yeah.
We answer questions. You saw we just did that, even though Tom was a little reticent. He was trying to
shirk.
You were trying to shirk your responsibility. Oh, well, I can't answer it. You didn't tell me enough. Well, that was pretty lazy. But see, he's getting ready for vacation a couple of weeks early. He's
taking a break from my vacations to do this show. You should be glad.
He's easing into vacation by vacationing during the show. So call us at 855-935-TALK, 855-935-8255.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
You know, time flies when you're talking about money. You're on Talking Real Money, the money talking radio program and podcast. And that's a good thing. It's kind of fun. 855-935-TALK is our phone number. That's 855-935-8255. I am Don McDonald in Florida. Tom Cock is in Duval, Washington.
Yeah, I'm skipping out on Duval days right now to do the show. So I want a little pat out in the back. I missed the parade this morning, but we're going to run down after the show and check it out. Check out the action.
Is there a rodeo, too?
There's no rodeo that I know. They had a 5K run last night, and this afternoon they got all the booths up and down, Main Street and stuff. So we'll run down there and have a look.
The booths?
So meet our neighbors.
Booths?
The booths.
The booths.
The David booths. Yeah. So we'll check that out.
Yeah, Duval days.
Yeah. Don't want to miss it.
I remember back in Duval days. 855-935-TALK. That's our phone number. Call us. We'd love to talk with you about money, just like we're going to do right now with Justin in Florida. And Justin, welcome to the show.
Oh, hey, thanks for taking my call, Tom and Don. I appreciate you guys.
Our pleasure. What's up?
The question I had is, how do you guys figure up valuing a pension when the pension has a cost of living adjustment and survivor benefits? I know it doesn't really calculate into your net worth, but how would you value a pension, and then when trying to reduce the amount that you might need to save in your IRAs or 401ks?
Yeah, that's a fascinating question. I mean, when we do planning for people, we don't look at it that way. What we look at is regular income sources of Social Security, a pension, could be an annuity, I guess, if you own one. Regular sources of income. That is part of the equation. The other part of the equation is the thing you mentioned briefly there, Justin, the savings you have, because that would then supplement those other sources to pay for whatever you need.
Let's turn the equation upside down, because I think you're looking at it the way most people look at it, which is the wrong way. It's the wrong way. We believe that the first thing you need to try to calculate, and it's not exacting by any means, is you need to figure out what kind of an income are you going to need in retirement. You determine roughly what that number will be. So let's say it's $8,000 a month you need in retirement. I need $8,000 a month, and your pension pays you $4,000 a month, or will pay you $4,000 a month. And Social Security is going to give you another $2,000 a month. So now you know what your hole in your income is. Now to fill that hole, you know how much to save, or relatively close to it, because you want to add that $2,000, and you probably want to give yourself some wiggle room. So to get to that number, roughly, you're going to need between $600,000 and $750,000 to generate about $2,000 to $3,000 a month in reasonably secure income.
And is this a municipal pension, a government pension, or is this from a private employer?
This is a government pension from the Army.
So it's secure.
And there's no payout. You can't go get a amount from.
Yeah,
you can't cash it out.
But we really believe in starting with the income and then working backward to the assets, as opposed to starting with the assets and going, well, what's my annuity worth as an asset? It's really not, because you can never cash out that asset. So I don't want to assign a value to it. I want to look at what part of my income that will make up in retirement.
Awesome. You guys have time for a second question?
Sure, absolutely.
Yeah. And first of all, I want to say thank you for your
What do you guys
service. And
think
by
about-
the way, great picture in the news today of a 102-year-old D-Day survivor being congratulated by current soldiers. I love it. It's out there on the web, so check it out. I loved it. So Don says no big deal.
That was
I say
awesome.
big deal.
Yesterday was the
Anyway,
anniversary.
it was.
So.
That's correct. Yep.
Yeah,
Go
and
ahead.
Tom will be there in 2 weeks.
Yep.
I'm sorry.
I'm to be. He's just saying I'll be on the beaches here in 2 weeks. So go ahead.
He's a little late to the party.
I'm safer though.
Yeah, a lot safer. Anyway, what's up? What's your other question?
The thrift savings plan. What do you think about keeping it in there when you leave, or rolling it out into, like Fidelity or Vanguard or Schwab? What do you? Because the fees are pretty much as low as
Yes.
anyone.
Yeah. Here's my take. I just talked to somebody about this today that has a lot of money in the TSP. I love the plan, but I would still only have one pre-tax, like one IRA. So if you have an IRA separate from that, then I would move it into that IRA. I would have it all in one place. I wouldn't have the TSP plus an IRA. But otherwise, it's okay to leave it there. Sure.
Yeah, and if you leave it there, I mean, you are paying a lot less, and you can diversify outside.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping
Just to be sure, did you guys want to keep Justin?
investments and praying your gut instincts are smarter than Wall Street,
You got it?
it's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
It's your money, and of course, it feeds your existence, and it's the source of comfort, security, and a little bit of pleasure along the way. You need to manage it properly, and that's why we're here every week to try to help you on Saturdays on Northwest News Radio and then on our podcast regularly. 855-935-TALK is our phone number. That's 855-935-8255. And let's go to another podcast listener from Ohio. John, welcome to the show.
Hey, Don and Tom, how are you?
Good. Thanks for calling.
Yeah. I have a Roth IRA and a traditional IRA under management with Fidelity, and I'm trying to figure out why my management fee from them varies so much month to month. Do you have any ideas, like what might be causing that? Or,
Well, is it based on the balance in the account?
well, there's $750K in the two
Yeah.
accounts, and then the regular management fee, is 0.98.
Yeah.
But the monthly fee is like it runs anywhere like $2,800 a couple months, $1,800 a couple months. December
Well,
or January.
no, that doesn't
was
make sense.
$4,500.
Yeah, no,
Okay,
that doesn't make sense.
Let's look at, I assume you have a statement right there. It sounds like you do.
I have a statement close by, but
Okay.
I am blind, so I can't.
Do you know what the line item says specifically, that this item that you're seeing at
Yeah.
all of these different prices? What do they
Yes.
specifically call that line item?
Fidelity management fee.
On each one, even though there are different amounts?
Yeah, every month on the statement, it has, the current balance, previous balance, the changes, everything. Fidelity management fee, $2,800, $1,800.
Do you have a year-end statement, John, that shows you how much you paid in total fees for the year? Or do you have a recollection of that?
No, but I...
Okay, because, I mean, my numbers, round numbers, it should be about $7,500 a year. Right? 1% of $750,000.
Yeah. Well, like I was wondering, do they roll in all the expense fees?
No, because you'll never see a charge for the mutual fund expense fees, because those are built into the fund's net asset value. They are reflected in that net asset value. Any charge that they're showing as a fee, a management fee, would be like a managed account fee. And Fidelity's managed account fees, their advisory fees range from, for example, in their strategic disciplines account, it's like 0.2% to 0.5% a year. And there are some other fees for trades and the like, but I don't.
Yeah, but that wouldn't end up anywhere being that amount.
Yeah, I am.
Like I was wondering if they're like trying to rebalance my funds, like the traditional is a 60-40, but the Roth IRA is 100%.
Yeah. Now in Fidelity Wealth Management, those fees go from 0.5% to 1.5% for a private money manager.
Yeah.
But they shouldn't fluctuate that much. And so this is, if you're paying, which you sounds like you're paying a hefty fee for an advisor at Fidelity. I mean, it may be way too much. I would absolutely get on the phone with Fidelity Monday. Call my advisor and say, please explain to me every one of these fees on every one of these statements and what they represent, how they're charged, and why they fluctuate.
And I'd want to know the annual amount because, again, just ballparking it here, the numbers you gave us in no way match up to that $7,500 a year charge.
Yeah.
Right. Like I was coming up with like 3 times that.
It sounds, what they're showing you is more than you should be paying. But again, if we can't see it, so it's hard to comment on it. But this is absolutely a question. You have an advisor, for heaven's sake, to whom you're paying way too much money. So that you got to smack them upside the head and say, explain this to me as if I was a 5th grader.
Yeah, and I don't know about hitting them, but I would get the numbers.
I meant that figuratively.
Okay, no hitting.
Do not actually smack them upside the head.
It's your money, and you should know. I agree.
All right.
Okay. I thought I was missing something.
Yeah,
I thought I was missing
doesn't sound
something.
like it.
Do me a favor. When you find out, call us back and let us know. Because, we're curious. All right?
Yeah.
Thanks so much.
Thank you for your call.
Thanks a lot.
Thanks, John. Take care. 855-935-TALK is our number. Let's go to Virginia. Will, welcome to the program.
Good afternoon. This is Will. How are you?
We are well, Will.
And I wanted to check in with you. Hi, Tom. Don, we've been told a couple times your birthday's coming up.
Who told you? I probably mentioned it, didn't I? Yeah. Yes, it is, and I'm going to be another
just a
year
few
older,
weeks away.
but not deeper in debt. That's the good news.
No, he won't be deeper in debt, but he will be older.
But I will be another year older, and yes, it is my birthday. And what's the date today? I don't even know what the date is.
Today's be June 7th, just for the record. Yesterday be June 6th, the anniversary of D-Day.
So. A little over 2 weeks. 2 weeks.
2 weeks.
Yeah.
About mid-month.
Yeah,
the 24th of June.
Hey, you're giving the date away.
Sorry about that. Happen to know that one because my dad was born on the 24th of July, so it's easy to remember.
Born on the 24th of
And
July.
you're just much younger than he. His 100th birthday is coming up here in a month and a half. So.
And mine is not.
No, you're not even close.
Not
you're
even
a mere
close.
pup compared to that.
So thanks for reminding me that I'm getting older. And I don't know why you called. I don't know why you had to tell me that, but
we're going to take donations just to get him a gift or something. So we'll do that.
All right.
Okay, appreciate it. I just wanted to they were thinking of you. And we wanted to tell you that, we're about midway point. That institution with major facilities in your state in Florida says we're about 13.8 billion years old in this universe. The universe existed for about 9 billion years before our solar system was created.
Are you talking about Disney World?
I'm talking about NASA.
Oh, NASA. Okay, I was going to go. Which one is it? I don't know.
You had me going
We
there
got
for a
Disney
minute.
World, we got Universal Studios, and we do have NASA.
I thought he was talking about the length of your radio career for a minute there. So only one
Billions
goes in the
and
billions.
billions of years.
About 4.5 billion years, the solar system finally, after 9 billion years, took form.
Yeah.
And in about 4 billion years, it'll be joining Andromeda.
Yeah.
As long as we get another 100 years out of it, that'll cover everybody I know. So I'm okay with it after that.
The darn galaxy took its sweet time in coalescing, didn't it? I mean,
exactly.
really.
Get together, people.
It didn't take us that long to make this show, and it's a lot hard. No, it isn't. Anyway,
only
thank
took
you
one
for the
day.
call. We appreciate it, Will. Thanks so much. I appreciate the
Are you
wishes.
going to finish your quiz? Because we didn't get to the end of
I
this
am
quiz.
going to finish the quiz, but I'm going to finish
All
it
right,
after
better
this
hurry.
break.
Okay, hurry up, because you got 2 more questions, and these are
Two
big ones.
whole more questions.
Big
Two
questions, my friend.
questions. Really?
Bigger than your birthday, yeah.
Yeah, we're going to get those in. We're going to get those in.
Is it-
if I could
is
skip
it-
the birthday, I would.
Can we ask the year? No, we won't ask the year. That's not
I'm
nice.
old.
It's long, big
I think
number.
I've mentioned it. I went a little early on Social Security.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
My granddaughter sent me a birthday card. It was cute. It said, those who have more birthdays live longer.
She said,
Duh,
wait,
duh.
you're that old?
Yeah.
Crazy. Yeah,
All right, sharpen up your number 2 pencil. Here's question
Please.
number 8.
Yep. Yeah.
You buy bonds from a corporation and notice that the company can buy the outstanding bonds from you before the maturity date. What is this feature called? A put feature. B, a buy right feature. C, a call feature. D, a take back feature.
Yeah, this one's actually pretty easy because it's a callable bond. This is a call feature.
Why do you say that's easy? Most people don't know
I don't know.
that.
Just it's one of those things that it sounds like call the bond, call it in. Or,
Hello,
so
Bond, I want you to come back.
come over for Don's birthday party.
And,
so yeah,
and middle
okay.
schoolers, that's just if you say something, you just have a take back feature. Oh, take back. I'll take it back.
Take back. Oh,
9. Question
Yeah,
9. This is
this
the
is it.
9th and final question on our quiz.
This is a difficult question, so listen carefully.
Yes. It is actually pretty difficult.
Yeah, it is.
Susan wants to buy XYZ stock for a specific price of $30 or less per share. And she understands that this request will be executed after all previously received orders have been fulfilled. What kind of order should Susan submit? This is like Series 7 material, ladies and gentlemen.
It is.
You get
Yeah.
this right. You are an investing pro. You're
We'll
actually not.
we'll
You're
get you part of the industry. We'll get you
you're
in the
not-
brokerage
You're
industry.
a gambler because it means you're buying individual shares.
Exactly.
So.
Yeah, thank
All right,
you.
You really don't need to know this. Never mind. We're not even going to discuss it.
Okay.
No,
Let's
we're
just-
going to discuss it.
Oh, okay.
A market order.
Yeah.
B, a limit order. C, a stop order. Or D, margin order.
I believe it is a market order.
That's only because he cheated and checked. No, actually, it's not. It's a limit order.
It's a limit. I've literally never done anything like this.
A limit order means that I don't want
market
to pay.
just means whatever you
Market
can,
means like, let's say the stock is, right now it's 30.
The price.
You put in a
Yeah.
market order and the stock moves
Yep.
very quickly up and you buy it at 31. That's a market order.
Yeah.
You're
Whatever
saying,
it is.
I don't want to pay more than $30. I want to put it in with a $30 limit. I'll pay 30 or I'll pay less, but I will not pay
There
more.
you go. Yeah.
That's what a
I
limit
guess
order
I
is.
guess I need to go back to high school. I'll call
Well, you don't have
see
a
if they can
Series
get
7.
me in.
See, you never
No,
took
I don't
you
have
never took the
Series
Series 7,
No,
which
I
is for
never did.
stockbrokers because you don't buy individual stocks.
Nope, I do not.
You don't
Nor do I
execute
recommend
trades.
it, by the way.
Yeah.
No.
So,
All right.
anyway,
Sorry
that's
about
the
that.
quiz, and it was a fascinating thing thing that we do now for some high school kids. Problem is, it's not enough high school kids. It's only 18,000 of them who participated in this competition.
Would you figure out 1/100th of them or something?
It's
small
tiny.
number.
Yeah, 1/100th.
My daughter would not do well with that quiz either, by the way. I'll just say that. So, and she's a smart kid and a good student, but she wouldn't do that.
You're in the Scripps Ranch income range.
I personally?
Yes, you personally are.
I see.
All right, we got to run. This hour is coming to a close, but we want to remind you that, one, you can call us at 855-935-TALK. Two, that you can send in your questions at talkingrealmoney.com on the contact form. And three, if you want to spend some time talking with Tom or any of our fiduciary advisors for free for nothing with no high-pressure sales pitch, go to talkingrealmoney.com and click the button Meet an Advisor.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.